When a lawful permanent resident has had their lawful permanent resident status for at least 8 of the past 15 years, excluding any Form 8833 treaty election years, to be treated as a non-resident alien, then they will be considered long-term. They may be considered covered expatriate, and they may be subject to the exit tax. But just because a person is an LTR does not mean that they will be subject to an exit tax. It goes like this. The first step is to determine whether you qualify as a long-term resident, if there's any exceptions, exclusions, or limitations. Even if you qualify as an LTR, then the next determination is whether you're a covered expatriate. There's three different tests: the net income average tax liability test, the net worth test, and the 5 years tax compliance test. If you meet any one of those three tests and you're considered covered expatriate and there's no exceptions, then you have to do the calculation to determine whether you're subject to exit tax. So important to remember, not all long-term lawful permanent residents will be subject to exit taxes when they terminate their U.S. person status.